Dear students, Assalamu alaikum wa rahmatullahi wa barakatuh. I hope everybody is doing well and in good health. Today our topic of discussion is risk and return. As you know, this topic relates to the book by the name of I think Investments, Analysis and Management. But the title of the books we have in our curriculum is Investments, Analysis and Portfolio Management. But whatever, we are following this book, and the author is Charles P. Jones. I think this is 12th edition, and I'm going to share this copy of the book inshallah with all of you. And the topic we are discussing today is, I think, in chapter number 6. Just check it in the contents we have here, and chapter number 6 is the returns and risk from investing. But we are following the slides of this book. Okay, dear students, first I'm just trying to explain what is return. So the definition of the return, simply we have, according to this book, income received on an investment plus any change in market price, usually expressed as a percent of the beginning market price of the investment. So dear students, most of the students, they are confused in the meaning of return and profit. We have return, profit or earning. So how you can differentiate? What's the difference? Very much simple. I'm just giving an example. For example, if you make an investment of $1,000, right? You make investment of $1,000. This is your investment. But after 1 year, you have earned how much? $100. This is your earning. Maybe this is a dividend or interest or whatever sort of return that could be. Okay, so generally we say this $100 I have earned within 1 year is my profit or my earning, right? Or net profit or whatever. You cannot call it your return unless you divide $100 over your investment to know how much percent your profit is in the investment. So very much simple, dear students. Whenever you divide 100, this is the profit or earning or whatever, over the investment, then this will give you, I think this is equal to 100 divide 1000 is equal to 0.1. But when you multiply this with 100, okay, this is equal to how much? 10%. So dear students, very much important. How much is return here? Return in our example here is 10%. So what is the difference between profit and return, or net profit or earning, whatever you have? This $100, this is usually, as you can see, that is shown in amount. This is $100. But when you try to know how much is this as a percent of your investment, that is 10%. So there is a difference, right? Because if somebody asks you that your return is 10%, but you cannot know how much this 10% can be unless you don't have $1,000 with you, right? Also, if $100 is given but initial investment is not given, then you cannot figure out how much $100 as a return can be, right? You cannot compute it. So that is why the difference between return and the profit is whenever you divide $100 over the investment, that is giving you what? Return. We call this 10% is return. Okay, now in this definition we have income received on an investment plus any change in market price, usually expressed as a percent of the beginning market price. Okay, dear students, in this definition we have two things. One is income. Okay, as you know, we are focusing here financial securities, financial market. That is why the example or the formula, whatever we have, is talking all about the financial securities. Okay, So when you make an investment and you receive an income, and the income can be interest, can be dividend, right, or whatever sort of return that can be. So we say the income. So the income, and also we have change in market price. So the change in market price, for example, you have made an investment $100,000 or $1,000, and after a year the security price increase into $1,100 or decrease. So the increase in the price of the security, that is called capital gain, or the decrease is called capital loss. So in this formula, as you can see here, is we have capital gain or loss, and here we have CFT, which is the cash flow at time t. And that can be, this CFT can be dividend, that can be interest, right, plus if you have any change in the price. So if you have $1,000 in the beginning, and then after a year it changed into $1,100, so the price change, that is $100. So $100 plus if you have any dividend, both of them should be added together and divided over the beginning price, and this will give you the total return. Okay, I'm gonna just make it more clear with example. So look, dear students, we have two components of return. As you have seen, one component we have is safety, and another we have price ending minus price beginning. This is capital gain or capital loss. Look, we have yield, which is the basic component many investors think of when discussing investing return, right, as I've explained. And we have capital gain or loss. So the yield can be interest or dividend. And capital gain or loss, capital gain when there is appreciation in the price. For example, the price increased from 1,000 into 1,100, so that is called capital gain. But if the price decreased, that is called capital loss. Okay, so the decrease in amount, how much decrease you have suffered losses, so that is why that is called capital loss. So in a very simple words, you can say total return equal yield plus price change. As I've explained, what is yield? Yield is the return, that can be interest, that can be dividend, plus the price change, and then the total should be divided over the investment. Okay, I'm just practically showing you how you can compute and measure the return. Okay, in the book, and just if you come down, we have an example, right? We have this table 6-1. We have historical composite stock price index based on Standard & Poor 500 index. So this is the Standard & Poor 500, which is the stock market, stock exchange. 500 stocks are listed in this stock market, and the group of these stocks, we have the data of the stocks here. We have year, okay, which is starting from 1925 in the example up to 2011, right? And here we have index value, that is the ending price of the stocks, right? And here we have dividend, that is which is annually given by companies, right, to shareholders. And here is the total return. This is the total return computed in the column. I'm just going to show you how these total return, which is shown in the percentage, right, computed here. So I'm just taking a snapshot from this table and just copy it into Excel. Look, dear students, I've just taken a snapshot. Look, from 1969 up to 1978. So these are the ending prices of the stocks we have, and these are the dividend given annually, and this is the total return. I'm just letting you know how these total return, right, these are computed. Okay, first just type year, we have index value, we have dividend, and then we have total return as a percent. Okay, just copy all these years here. So we have 1969 and then we have 1970. So just drag it down to 1987. We have here is 87, right? And now copy the values. We have index value 92.06, 92.15, and right, then copy the dividend. We have 3.16 and 3.14, and just put all the data in the column. Okay, now how this column of total return computed? The same formula we have here is used. I'm just letting you know how it worked here. Okay, first you need to just add one column by the name of return, because that is not given here. So first you have to compute the return, and then the dividend is already given, and then you have to compute total return using this formula. So look how this is done. Okay, for example, you have invested in the price in 1969 is 92.6, right, 0.06, and after a year the price, as you can see, slightly increased, right? And then in 1971 it jumped into 102.09. Okay, as you can observe, in some years there is decrease in the price, in some years there is increase. So you can say here in these two consecutive years we have capital loss, we have depreciation, but in these two consecutive we have appreciation. Okay, but in the first year there is no return. You have to check how much your return is at least after a year. So what is the function? Just type equal sign, and from today's price or the ending price in 1970 we have minus the beginning price we had, and that is E7. Okay, so it's mean in the first year, after a year 1970, how much return you have generated or you have earned, that is 0.09. Okay, and now how much is the dividend that is already given. So you can just drag down, and all the values are automatically computed. So look, dear students, from 102.09, 92.15, which is the previous price of the stock, subtracted. So you can see how much is the difference here. We have 9.94. Again, here is we have appreciation, that is equal to 515.96, but here we have depreciation, because from 118.05 decrease into 97.55, which is negative value you have. Okay, now we need to compute how much is the total return we have. We are using this function, right? Look, the price ending and the price beginning we have computed, and that is just a minute, we have computed some problem here. Okay, and you have, so price ending, price beginning, this is actually the price ending and price beginning, but you can just write here price ending, right? Price ending PE minus PB. This is price ending minus price beginning. But if you divide all these values, right, over the initial investment, then you can mention here, you can call it your return. Now this is appreciation, or you can say this is your profit or yield, but not necessarily return if you do not divide over the investment. Okay, dear students, how you compute the total return? Here we have, in this formula we have price ending and price beginning we have computed, plus you have to add it with CFD. This CFD, this is the dividend or interest. In our case here we have dividend, so The dividend you have to edit with these two values. So I'm just adding these two values. So equal sign and start the bracket, and we have price ending minus price beginning, right, and plus we have dividend, and the whole amount should be divided by price beginning. And how much is the price beginning in our example is 92.06. So divide by 92.06, or just simply click on this value. Okay, we found one value, and the same you have to do in the second row also. Equal sign, and then we have price ending, price beginning. This should be added with the CFT, which is the dividend here we have, right, and the whole should be divided over the beginning. Okay, this is beginning, right, for 1971. Which one is the beginning price? This one, and this is equal to 0.41183, and just drag it down, and the whole values, all the values are computed automatically. Okay, and this is the benefit of Excel. Just you can do everything efficiently. Okay, now click on this percent sign, so this to convert it into the percentage values, and here we have all these values. Look, so start from here, because in the first year, as you know, we cannot compute it, because for this year we must have a value of 1968. So that is why we are not having it. So that's why I couldn't compute it. Okay, here. So starting from here, look, all these values we have 3.51%, 14.12%, and this way all the values computed. So what is the interpretation, dear students? You can say at the end of 1970, right, the return is 3.51%. If you make an investment of 92.06 after a year, how much is the total return? 3.516. And how much is return here? So you can say these are the returns in between each consecutive years. So you can also call it, this is the rate of return. It means in 1971 the return you have 14.12%, here 18. Why we have negative values here? Because here we have depreciation. So that is why the values are negative. I hope you got this, dear students. Okay, now in this example, the stock price for stock A was $10, as you can see, right, per share 1 year ago. The stock is currently trading at 9.50. It means 1 year before the stock you have purchased, the price was $10, and now it is $9.50. It means here is depreciation. You lost here. Okay, you're suffering slightly losses here, but the stock is currently trading at 9.50 per share, and shareholders just received $1 dividend. So this $1, this is the dividend. You can see this is the CFT, the yield, and here is we have the price change from the latest price. We have the last one, 9.50 minus the beginning, divide by the beginning, you can see 5%. So in this example, how much is the return? That is 5%. I hope it is clear. Okay, dear students, next we have return relative. So what is return relative? One, we have relative return, and one is return relative. Okay, try not to confuse, both are a little different. I'm not discussing relative return. Relative return is when you try to compare two returns, and there is a standard is given, and when you try to compare two values with a standard, which value is comparatively doing well, look into the standards. So when there are two companies, or if you just try to compare the return of both into the standard return, then we find out relative return. But here in this example we have return relative. Total return can be either positive or negative, right? So what is the function of return relative? And very much simple, whenever you try to add with the total return 1, that will compute return relative. As it is here, total return can be either positive or negative. When accumulating or compounding negative returns are problem. Once again, dear students, look here. In this example, we have total return, as you can see here. But in these total returns, there are some negative values. But in computation or in statistics or in computing geometric mean or arithmetic mean or some other calculation if we require, or for standard deviation, right, we have some negative values here. So in order to eliminate the effect of these negative values, we are computing return relative. And how to compute it? The return relative, just to add 1 with all these values. How? First, I'm just trying to just remove the percent sign back from this. Look, make it just total return without the percentage, and then add all these values with the total return plus 1. Just add 1 with each and every value and drag it down. Now all these values, each value we call it total return relative. Okay, this is our total return, and whenever you try to add 1 with each value, this is called what? Return relative. So dear students, what is the function as I've explained? I told you if you try to convert the negative values into the positive, then you have to compute the RR, return relative. And this return relative is used in many functions like in geometric mean or in arithmetic mean. But what is the interpretation? If you try to interpret all these values, you can do it. How? For example, here we have 1.03. This means we are just comparing all the value with the standard 1. So it's been the return we have generated that is more than 1. By how much? By 0.35086. If the standard that is 1, we have 1. So it's mean the return in this example, it's mean comparatively to each dollar, in each dollar how much extra you have computed, 0.35 from 1. This is an interpretation. Usually the purpose of the return relative is not interpretation like this. This is usually return relative is used in functions like geometric mean, arithmetic mean, or in calculation. But anyhow, if you just try to interpret, once again, look here, from 92 the total value increased into 92.15. Here we have appreciation, and here we have a dividend. So in a very much simple word, the total you have earned 0.035086. It's mean if you invest $1, right, so the $1 will turn out 1.035086 after 1 year. This is another interpretation. You can say $1 investment, that will become 1.03. But here if you make an investment of $1, that will become 1.141. But here if you make an investment of $1, that will become 0.85. It means 15 cents less than 1. So here is you are suffering losses. I hope it is clear. Okay, dear students, how you can compute return relative? Very much simple, as I've explained. If you have computed total return, so just plus 1 with that, and that will give you return relative. And look here, total return can be either positive or negative. When accumulating or compounding negative returns are a problem. A return relative solves the problem because it always is positive, right? Okay, you can also use this function, this formula also for return relative if you want to compute. So this is a CFT. You have to add it with price ending, and then you have to divide by the price beginning. In our example, look here, if you want to just do that way, so how much is the CFT if you want to compute return relative here? So how much is the CFT, that is the dividend we have, right, plus, and price ending, how much is the price ending? We have 92.15, right? And sorry for just start the bracket, we have a dividend plus, this is price ending, and divide by price beginning. How much is price beginning? 92. So look here, again you can use this way also, 1.035, drag it down, look, simply that is same. Okay, one way is just to add 1 with this total return, another way is just use this for function or formula. So safety plus price ending divided by price beginning, as it is here. Look, we have here safety plus price ending divided by price beginning, and this will give you return relative, or equal sign to this function simply is equal to total return plus 1. So dear students, I think you have learned the concept and the idea of return relative, and inshallah very quickly you will just observe how we can use the function of return relative in different numerical exercises. Okay, next we have measuring returns. To measure the level of wealth created by an investment rather than the change in wealth, need to cumulate returns over time. Okay, how to compute the wealth. For example, if you want to make investment in this example, if you make investment here in 1969, right, if you want to make investment of $10,000, you purchase $10,000 shares values, and after few years, for example in 1973, how much the total wealth will increase. If you make investment of $1, so this $1 will increase into how much in 1973. That is the purpose of cumulative wealth index we have, right? What is cumulative wealth index, which is CWI? I'm just explaining with example, and this is a function. I'm just trying to explain this formula also. So look here. Okay, first cumulative wealth index, you can just write like CWI is an abbreviation, or n periods. So this is cumulative wealth index at the end period of n. I'm just explaining. It's mean if you want to just try to check how much your wealth increase after 5 years or 3 years or 10 years, right? And this is, we have wealth index 0, the beginning index value, typically $1. How much is your initial investment, you can say here, and this is the total return, right, starting from 1 up to n years. So the periodic total returns in decimal form, this should be in decimal form, not in the percentage form. When added to 1, they become return relative. Okay, I'm just explaining the purpose and the concept, so just look here. Okay, in this example, look here, assume if you want to purchase here $1,000 amount of shares, right? If you want to make investment of $1,000, for example, or 10,000, let me make it 10,000. Okay, how much total fund, total money, how much this $10,000 will increase to in year 1976, in year 1976. Okay, if you want to make investment right now in 1969, and if you want to keep it with you, right, and continuously, if it compounds, right, and you're receiving return, then in 1975, how much this $10,000 will increase? Or if you have $1 here, so the wealth or the value of $1 will increase into how much? So dear students, in very much simple words, here we are just checking that how your wealth increases, right, rather than to know the total return in between each 2 consecutive years, as we have explained here. So look how we can do it. We can use this function, this formula. Okay, so look here, what I'm just doing. First you try to compute 1 plus total R, and we have total return is already given but we try to remove percent because these values are not in the percentage. And then you have to add tr 1 with the tr, and we have added 1 with the tr, so the return relative is already given here. Now we are using this formula. So look here, we have cumulative wealth index for n, okay, for 5 years. We just want to check for 5, or you can say from 1970 into, just a minute, this is just try to make it simple, from 1970 to 1975. Okay, look, I just try to check the cumulative wealth index from 1970 into 1975. It's been from this year onward into this year. So we have how many years? We have 6 years. It's mean if you want to make investment according to this structure, right? So in these 6 years, how much wealth will increase? So we have this formula. So look here, now just a minute, I'm just using this function. Okay, in the beginning, how much is your investment? $10,000. Assume we are just using $1, because you can later on multiply the end result with $10,000. Also you can use $10,000 like this. You can use $10,000 also. Simply for the sake of simplicity, I'm just using $1. If you have $1 right now with you, right, and according to this we have 1 plus tr. So 1 plus tr is given, this one, right, in 1970. Then plus we have in this 1 plus tr in the second year, right, and plus then we have 1 plus tr in the third year, right, and then you have to continue for how many years? For 6 years. I think 6 value. We have 1, 2, 3, 4, 5, 6. Okay, once again, very much simple. Okay, and this formula, first you have to just write $1, or you can also write $10,000 but just for the sake of simplicity, type $1, and then 1 plus tr, which is return relative, which is given in 1970, starting because it is starting from 1970 and up to 1975. So you have to take all these values, and I've just taken return relative in 1 year, right, another year. But keep in mind, dear students, I have just added here, because you need not to add, because each 1 plus total return here, they are multiplied. But I'm very much sorry, because I have just use the plus sign, but you have to use the multiplication sign. Why? Because just a minute, instead of plus you have to use multiplication. Okay, because all these are brackets and they are just multiplied. So here 1 plus tr, which is the first value, multiplied into 1 plus tr, the second value, multiplied into the third. So you have to just do it for 5 years and press enter. So the answer we have here is how much? Okay, here I just think I have made mistake. Okay, you just remove this dollar sign, because in this formula it is not accepting, and just press enter. Now it is okay. Now, okay, that is equal to 1.2143. What does it mean? It means if you make an investment in 1970, if your total value of the share in 1970, that is how much? that is $1. If it is $1, so after 5 years in 1975, the wealth increase into 1.2143. It means $1 will become 1.21 if you want to make investment. Okay, so from 1970 into 1975, your cumulative wealth, right, that is 1.214. In simple word, now you just click on this to convert it into the dollar amount. If you want to make investment at the end of the year 1965, and if you want to check how much your $1 will increase in 5 years, in 1975, that will increase up to 1.21. Now if you want to make investment of $10,000, you just can multiply this $10,000. so you can say equal sign 1.21 multiply into $10,000. so the $10,000 will become how much? 12,143.12. If you want to make investment of 50, whatever this amount can be, so just multiply with this rate. So that is why I have used in this function $1, so that you can use any initial amount to multiply with the end result. So dear students, this is what is called cumulative wealth index. But I've just tried to show you manually this function, but very much simply you can use the function also. The formula, we have a function in Excel if you want to just check. So that is equal sign and just write product. Okay, simply write product and how many values you want to check for 5 years. So just select 5 values, and if you want to check for 6 years, so select 6 values and just press enter. So look, the same answer we have here. Okay, if you want to use the function of the product. Once again, dear students, manually, as I've explained here, that how much is your initial amount. The initial amount, which we call is WI0, wealth index at time 0, that is $1. And then we have 1 plus TR, this is 1 I8 and 1 I9, I10. These are the values of the return relative, because each of this value is return relative. And then you have to multiply all of these values, and this will give you 1.21. And the simplest way you can use is just type product and take all these 6 values, and then that will give you the 1.21. And this is the purpose and the concept of the cumulative wealth index, dear students. Okay, next we have cumulative wealth in total return. Okay, dear students, we can also compute total return using this function. If you remember, if you try to compute the total return between 2 consecutive years, this is the total return. Here we have computed, and how you have computed: first you have to find out the price ending, and then price beginning, and then dividend, and add both of these values here, right? You can also find out this total return using another function, right? And that is this function, this formula. Just let me copy this. Okay, dear students, this total return, as I have simply explained how you compute all these values, but you can also use this formula. This is a rate of return. If you want to know how much is the rate of return between these 2 years, so this is equal to 0.03, and how much is the rate of return here, this is equal to 0.14, and the rate of return here, this is equal to 0.18. So this is the rate of return, and this rate of return, if you just want to find out using this function, have, so very much simple. If you want to find it here, in any given year you can find rate of return. For example, I just try to find out the rate of return between these 2 values, between these 2 years. Okay, so how you can find the rate of return is already given here, 1.2, but you can also use this formula to find out how. Look here, in this formula we have cumulative wealth index for any year. So we start from where? From 1965. So we have the n values. How much is the n values here? These are the n values, right? So if you want to check the rate of return in 1976, right, in this year, So how much is the number of n? Start from here, 2, 3, 4, 5, 6, 7, right? You can select any number values of n here, any values. You can start from here, you can start from here, from any value. But in our example, I just take all these values from the beginning up to this value. This is our n, okay? And then you have to divide it by cumulative wealth index by n minus 1. So this is n minus 1. So look how I'm just doing it using the formula. So equal sign, first you have to write product. In the product, you have to take n values. So cumulative wealth index, this is n, take the n value. So I'm just starting and taking the n values from here up to this. So the n values I have selected, they are how many values? 7 values, right? Now you have to divide this again, take the product and n minus 1. It means now you have to take one value less. Look, this is n minus 1, okay? And whatever is coming, then you have to minus 1 from. So just press enter, and from the final value minus 1, okay? So equal sign, from this minus 1. So this is equal to how much? 0.23, exactly the rate of return we found. Look, 0.23 is given here, and that is also given here. So dear students, I have just simply explained, if you try to find out the total return using this formula, you have to take cumulative wealth index of n years, right? As you have seen here, we have taken, so you have to take n years here. So I'm just using the same function here to find out the total return manually. So you have to take n years. So in this we have taken 6 years, so just increase one more, static, and the last value also, okay? And then this is the first value, which is cumulative wealth index. Okay, we have nominators and we have denominators, okay? So we have taken the nominators, then you have to divide this over the second. So you have to copy using the same manual method, copy all these values, right, and just paste it here, and just remove one value here because it is n minus 1, n minus 1. So look, cumulative wealth index in the nominators we have, in the denominator. In the nominators we have to take n values, in the n values, that is 7 values. If you want to check in 1976, right, how much is the rate of increase or rate of return, so we have taken all these 6 values, and then you have to divide by the denominator, the same cumulative wealth index but less one value. So I have just deducted here one value, and whatever the answer is coming from this answer, you have to minus 1. So equal sign from this value. So if you want to just find out the total return in the year 1976, right, in the year 1976, is equal to, from this value minus 1, as it is here 1, you have to subtract it, which value from this value we found minus 1, okay? So this is again, as you can see here, the same we found here, and also here and here. So in conclusion, very much simply, this function is used just to find out the rate of return as it is given here between each 2 consecutive year, okay? So dear students, this was the lecture for today, and I hope you have learned. And if you have any question related to this lecture, inshallah, you can ask me. So now we have only covered the first only one portion, which is return. Inshallah, in the coming class I will discuss risk and some other topics related to the risk. So dear students, have a nice time and wish you good luck. Assalamu alaikum warahmatullahi wabarakatuh.